Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. Our guest today is Neelkanth Mishra of Axis. It's a really special thing to have him on the show. Neelkanth, thank you so much for taking the time out.
Thank you for having me here.
The pleasure is entirely ours. So, Neelkanth, lots happening. Geopolitically, risk assets, so on and so forth. I would love to start off with that conversation or the question around risk assets. Post 2020, at least as per my observation, and correct me if I'm wrong, but it's largely been the central banking action which has driven the fates of what risk assets have done, now fourth year running. Do you see that changing, and if not, what could the impact be over the course of the next 6 to 12 months as inflation looks to be sticky and the central banks grapple with the mandate of employment versus inflation?
Yeah, so I would like to introduce a new variable in there, which is the fiscal stance of the US government. So the big change compared to the recovery after the global financial crisis has been that instead of tight fiscal, loose monetary stance, the preference this time is loose fiscal and tight monetary. Which is one of the reasons why the expected US recession is not happening. Just for perspective, the current run rate of the US fiscal deficit is 8.5% of GDP. This is just a federal deficit. Now, if you have a fiscal deficit at that pace, it is very hard to trigger a recession. Now, what this is starting to show up in is very sticky long-term rates. And you would have seen the 10-year bond yield is at 4.37. The expectation going forward, and we have an Axis Bank, we have written a lot of research on this, that why it is not just about inflation anymore, that the term premium that we build in going forward needs to go up. The R star needs to be much higher, which is the natural real rate. And therefore, the risk-free rate for the world, for global financial assets, which is the yield on the 10-year US government bonds, which we had become used to 2 to 2.5%, we now have to get used to 4 to 4.5%. And which means that a number of financial assets, the muscle memory of the market needs to move to much lower valuation multiples than it has become used to over the past decade. And this is not something that will show up in the next 3 months or 6 months. But remember that incrementally, if you were allocating assets to various classes, if you are getting risk-free rates of 4.5%, and as a corollary, interest rates on reasonable quality corporate bonds are at 6, 7, 8%, it is very difficult to see a lot of allocations happening to equities.
Yeah, I was about to ask that one, in effect, allocation to equities, 2, allocation to, let's say, emerging market equities within that subset, and 3, the valuation multiples that you mentioned because of the discounting rates. So, yes. Do you reckon the market is still not adjusted to all of these, and it'll happen over a period of the next 2 to 3 to 5 years?
Exactly. So then you were there, right? When 2010-11, when a very high quality stock trading at 40-45 times forward earnings would be considered very expensive. And then as the QE1, QE2, QE3 and sustained 0% interest rates kept happening, people became used to 45 to 50, then 50 to 55, then 60. And now you hear these really silly arguments that, oh, it used to be at 80 times, now it's at 70 times forward, so it's become cheap. Now, I think some of those benchmarks need to be revised downward. This will not happen very suddenly, because remember that it's a very large set of people, large set of participants in the markets we're talking about. But historically, and in the last 300, 350 years, there have been several periods where the interest rates were kept very low for a sustained period. And then because of other changes, they had to be revised up again. And then it takes several years for the markets to readjust back. So this is a sustained process. I'm not saying because of this, the markets are going to fall in the next 3 months, but I think the risk premium that equities naturally should have will be higher if you're thinking 12 to 24 months out.
Got it. What does this do to, for example, a market like India? And I have a lot more macro questions, but since we are on this topic, I want to get this out of the way. That there is a favorable position geopolitically, presumably from all that we are listening to, and there is a large tap of money domestically, which is following equities and very likely will only become wider with time. So what does this do to a market like India, which is in the EM basket, which technically, as per what you've just said, should attract lower flows, but in effect is also attracting higher flows because of the geopolitical favoritism, if you will, or not favoritism, but favorable placing, if you will, and the domestic flows?
No, so I think on the FII side, we have to remember that other than this 3-4 month period in the middle of this year, FII flows have been somewhat muted in India since 2015-16, and I don't expect that to change.
Okay.
So incrementally allocations, if India's weight in MSCI is 15%, some people may be at 17, some people may be at 13. Only the extremes, very few percent will be at 25% weight for India. And those weights don't change very frequently. So if EMs as an asset class, and exactly as you mentioned, if the attractiveness of EMs as an asset class fades or moderates because US rates are going up, then it's very unlikely that we'll get a lot of FII inflows. But at the same time, the second part of the second observation you had, which I think is very correct as well, which is that domestic flows, and I call them unintended flows, the unintended flows into equities. And the reason I call them unintended is that, every month there is some deduction happening from my salary. Every month, 15% of that is going into Nifty ETFs. Now, even if I want to, I cannot stop that. Similarly, on SIPs, I think, there is, of course, some knowledge that this is going into equities, but most of the investors are looking at it as fixed deposit. So if you just add that to the EPFO/NPS and add that to the allocations to insurance, where insurance, again, penetration is improving and some part of those assets need to go into equities, you are talking about a $30-35 billion annual flow into Indian equities. And you can see that behaviorally, that whenever you meet a fund manager, they're almost praying for the market to fall because they know this is very expensive, that this is going to be very bad for their performance, but they're getting flows and there's nothing you can do. So in this environment, if you think about India PE and global PE, this is India PE, this is global PE. Now, global PE, as we are saying, will be maybe drifting lower or going lower in the next 2 years. And India PE, because of all this flow, can remain elevated. But to think about this as an elastic string, beyond a point, it cannot stretch.
Yeah.
It'll start getting dragged down. And that's the dynamic, I think, that will play out over the next couple of years.
Okay. Well, we'll come to beyond the point at the SMID's end as well. But just before that, Neelkanth, it's interesting that you speak about the FI flows and the numbers. Of course, I'm sure, you know it better than most. But when I look at the narrative, or when I hear the narrative from fund managers or PMS or AIF managers in India who are now starting to get mandates from US-based money bags about wanting to increase exposure, when I hear some of the global bankers which are operating into India, they talk about how their clients want to increase exposure, it almost seems that in the long term, India being considered as a favorite or a better place than China and therefore more money to come in. You don't believe that will happen. You believe the weights will stay constant and the flows therefore will pretty much mirror what has happened in the previous 5, 6, 7 years.
I think we have to be a bit careful about the pace at which that transition happens. So the fact that that transition is happening and will continue to happen is my observations are similar to yours. I think where we perhaps disagree is that this will not happen very quickly. And we can even try to quantify that. So for example, of the $100 of FII holding in India today in the top 500 stocks, about One third is from sovereign wealth funds, from pension funds, from actual like direct allocations, and even those are mostly about percent of GDP. So if India's share of GDP is 3.5%, then 3.5% will be allocated to India. Mostly they do try not to do too much or too little, because they also face the fear that they could be timing it wrong or whatever. Right? About the remaining two thirds, which are mutual funds or at least benchmark funds or hedge funds, they have the same issue, and that they are stuck to a benchmark, and only about, I would say, 1/6 of that, so maybe about 10% of the total FII holding is from India-based funds, so India-focused funds, not India-based, but India-focused funds. The rest of it is India allocation through EM funds, global funds, Asia funds, or BRICS funds. Now, this transition will take a while to happen. So you and I may keep hearing that, oh, there's another $500 million of mandate from some sovereign wealth fund and they're looking for some India manager. Oh, there's another $1 billion coming here. But you think about it, that even 10 years back, there was FII flows of $20 billion a year that used to happen. So $1 billion or $2 billion here and there, maybe $4 or $5 billion over 6 months is not enough to move the needle. Remember that we are now a $4 trillion market. So you need a much larger sum of money to really move the needle.
Fair point. Okay, fair point. Now, a question on whether how do you foresee the equation between the kind of growth that the country would do versus what the markets could do? Because you did mention that up till a particular band of elasticity, India's PE and therefore Indian market levels might still stay elevated even if the global multiples go off a little bit. But growth is difficult to forecast, especially in a world which is slowing down around India. How do you see that dynamic?
Yeah, it's a very important question. I think when we think about growth, so there are internal drivers and there are external drivers, right? So the question is, how important are the external drivers? So services growth, or I say services exports, are about 10% of India's GDP. If the growth slows from, say, 15% year on year to 5% year on year, we are talking about a 1% erosion in headline GDP growth. So that's quite substantial. For goods exports, where we are at about, give or take, 12-13% of GDP, the decline has already started. So incremental drag may not be that meaningful. I would be a bit more worried about the imports going higher, because India seems to be the only place in the world where goods and demand is still elevated. And the world has added a lot of supply. So at Axis, we maintain a global goods demand tracker. And that demand tracker is now showing that the goods demand is well below the pre-pandemic trend. So in such a weak scenario, it is likely that global manufacturers will start dumping goods into India. Or, well, dumping is a strong word, that they will start. So Indian manufacturers now will face a lot more competition than they have done in the last 2-3 years. So those are the reasons why maybe the growth might moderate a bit over the next 6-12 months. But the internal drivers of growth are very strong. And I think the strongest is construction. And there, while there is some front loading because of state and central government spending on infrastructure, the recovery in the real estate market, I think, is a very powerful one. Remember that a very prime source of weakness in the US, in UK, in China, in Canada, in Australia, everywhere, it's the housing market, which is seen to be in a bubble territory and is correcting. In India, we've had a 10-year correction in the real estate market. And therefore, in the turn in the cycle that we have seen, and I'm sure you've been looking at the demand for cement being strong, cables and wires, PVC pipes, tiles, some types of MDF plywood and all that, not plywood, MDF, whatever, boards. This is all a sign that the independent home builder is also coming back into the market. and this can be a because think about it this way: if you went from 16.5% to 11 or some, I think 10% or no, 16% to 11% was the decline in gross value of output of construction as a percentage of GDP. Right? I'm not talking about GVA, but I'm talking about output, the value of construction, right? Because that takes in all the inputs from cement, steel, wood, and everything else. Now, if that goes up by 1% point, you're talking about a 3 trillion rupee increase in value of construction, right? And so while there could be a couple of $1 billion here and there or various types of things happening, but this by itself is a very large number. And when you sort of think about what this does to job creation at 12 to 15,000 rupee per month level, I think these are very substantial shifts. So this is what keeps me a bit optimistic that I think we will remain at 6.5%-7%, if not higher GDP growth over the next 12 months.
Couple of follow-ups. Does this typically follow as a cycle that after it's fallen and once it starts to make a bit of a U-turn, then it swings back, if not to the earlier levels of 16%, then some higher levels? Would it almost be a given in an up cycle of sorts?
Yeah, so the cycles, that's how so the reason why there are cycles is that there are self-reinforcing signals there. So what starts to happen is because some people have started to build, there is a certain pace of activity. That pace of activity gives comfort to people. I mean, some people have been very surprised at the crowds in the malls, the fact that for some of the hit movies, tickets are not available. I think these are all signs that the sentiment is getting boosted. I'm not saying it's all happening because of housing construction, but cyclically, once such a large segment starts to move, it creates a general feeling of goodwill. People feel more comfortable. There are more incomes being generated. If there are say 1 lakh people extra who get a 12,000 rupee a month job, then there would be 20,000 people who are supplying goods or services to them who are feeling better about it. And then some of them will build house again. And that creates another. So this cycle, when it turns for several years. It does not get over in 3 to 6 months.
But you're constructive for 12 months because that's what you're forecasting right now, but it could be a lot longer than the 12-month period.
It can be a lot. I mean, I expect it to be a lot longer.
Okay, got it. Okay, part one is that. Part two, there are some quarters of people who think on the economy front who've written off late that a lot of the capex that we're seeing is also front loading of the government expenditure and looking at the tight fist plus oil rising, so on and so forth. If private capex doesn't pick up the baton, then we might actually be running out of fuel to fund the capex. And then there is another side which says that they are seeing signs of private capex pick up as well. Now, I would love to understand how you are looking at this data.
So there is a supply side to this capex and there is a demand side to this capex. So the supply side of this capex is that the balance sheets of the borrowers and the lenders is the cleanest we have seen for the last 15 to 20 years. And this is where I think that when we are thinking of future growth, an assessment of balance sheets is very important. And the striking example I gave is of 2012, where growth was strong. You would have thought that, this is a fantastic time to be thinking about the next 5 years. But if you had looked at the balance sheet, you would have seen that leverage for corporates was going up. That was the year where in my previous firm, we wrote the House of Debt. The first of the notes for House of Debt was written. And that is when bank indebtedness was a problem. India's net international investment position was worsening because our current account deficits were growing very rapidly. And so the contra to that is what I see now, that firms have deleveraged.
Yes.
Banks are very well capitalized. The net international investment position has been, minus 10% for a while now. It is kind of flattened out. And so so from that perspective, the ability to do capex exists. The question is the demand side, meaning where do you need the capex? And there, I think we should be ready for some disappointment in the sense that if you're worried about global oversupply, if you're worried about, and see, most company boards, especially in large businesses, will think about that. So they will be looking at, for this type of chemical, we are already seeing dumping from China. And so does it make sense to add capacity? And so there are segments where India needs to add capacity, like, for example, on renewable energy, on energy storage, I think battery capex, there's some upstream electronics components, automation, renewable energy. So there's lots of stuff that we need to sort of invest on. And that capex, I think there is enough sort of fuel or enough supply of capital to fund that. But a meaningful expansion or acceleration from here, I think looks difficult to me. So, and you're right that there is a lot of front loading of infrastructure spending by state and central governments.
So what happens? I mean, Neelkanth, do you foresee that ability of the government side to fund the capex run out at some point of time because of the fisc situation, higher oil, etc., or you think it'll continue?
No. So I think the higher oil, that was okay. So if the central government is doing 10 trillion rupees of capex, and state government generally in aggregate do about twice that. So we are talking about meaningful sums here. So just a trillion or 2 trillion of potential increase in the subsidy bill is not something that can derail the whole cycle. So I would not extrapolate this beyond because see, you have a certain allocated budget. And you're just choosing to spend a large part of that in the first 9 months, because after December, January anyway, commissioning or inauguration of new projects is going to be very difficult. But that does not mean that when the next government budget is presented in July for FY25, that there will not be fiscal space to do more capex. So I won't go that far, but anyway, order flow, etc., is managed on a month-to-month basis, or a quarter-to-quarter basis, and for the markets definitely. So will the order momentum start to slow from here, or at least stop accelerating? I think there is a reasonable risk of that.
Okay. Last 2 or 3 questions. A lot of reference is being made to this current cycle having some similarities to 2003 to 2008, both on the capex and the equity front, but for the fact that the globe is no longer as robust as it was back then. How do you see this in relation to that, if it makes sense to see it that way? And what are the implications of this cycle, not just for the next 12 months, but beyond that?
I'm not very comfortable using, think about all the arguments that were made about whether the global environment is like the 70s or not. So the same I would hold true for, so there are similarities, there are notable similarities. There was a very big period of deleveraging because of Sarfezi in 2002, just like IBC forced a cleanup of corporate balance sheets. That time Sarfezi was doing that. There was a pandemic. There are notable similarities, and then of course the economy just bounced. But remember that China had just joined the WTO, and the real estate cycle in the US was likely to swing up, not down. The Chinese growth story was just picking up. Right now, we do not have any of that happening. So this is a very different cycle. And I would not extend the parallels. The fact that India has a reasonable runway of growth of 7% plus growth for the next 3 to 5 years is perhaps similar to what we saw then. But beyond that, I think it would be dangerous to extend that parallel.
Got it. I'm tempted to ask this question, and therefore I will. You made a reference to elasticity lasting up to a particular point. I'm extending that argument to what's happening at the broader end of the spectrum versus what's happening to mainstream equities, which is the large cap hundreds. Now, a lot of notes out there, a lot of notes since the last 3 months talking about how overextended the mid cap, small cap run is, and then it only goes further. Order books are there, etc., etc. Are you skeptical of levels in general in Indian equities and more so for the broader end of the spectrum? Or do you think this time around the cycle may actually surprise and skeptics may be proven wrong when it comes to the skepticism around mid caps and small cap companies?
No, I think PE multiples which are so stretched, and so while I have made the argument that global risk-free rates are going to be higher in the next 10 years than they were in the prior 10 years, and also that India's PE multiples will remain stretched, I think we need to be very, very careful about mid caps and small caps in India. There is a reason why they have always traded at discount to the large caps. There is one of the reasons why that same frothiness is not visible in the large caps yet is that large caps also have that disciplining factor of very large FII ownership. So whenever the valuations start becoming too stretched, then you have one seller coming to the market. In the mid caps and small caps, which are primarily locally held, that disciplining force is not there, and therefore, the fact that the valuations are stretched is a given. The fact that it is happening because of an incessant flow of inflows or inflows into mutual funds which are forced to buy that is also a given. Will this end in 3 months? Will this happen in 6 months? But with these kind of multiples, if you just do some back testing that if you bought these indices at these kind of multiples, what were your returns over the next 1 year, 3 years, 5 years? Those would give enough caution that if you are voluntarily trying to get into these segments, it would not be advisable.
Pertinent point. Thank you for that. My final question, Neelkanth, a bit of macro here. There is again divergent thoughts here, and equally intelligent people, equally cerebral people have given me both sides of the argument. I would love to understand from you. The talk of India moving towards current account or CAD neutrality, if you will, at some point of time in the next 2-3 years, and what it does to interest rate sensitivity, currency, and thereby the appetite for Indian fixed income as well as equity assets. What are your thoughts on this topic?
So I think there is a very reasonable chance that we do become current account surplus. There is a macro, there's a demographic reason for that. So whenever your total fertility rate drops below 2.1, for the next 20-25 years, the number of consumers per producer keeps dropping because your low age dependency ratio is falling. After 20-25 years, the old age dependency ratio starts to go up. So that's when the savings rate starts to come down. But for these 20-25 years, every individual will be saving more, right? So they'll be saving for their retirement, and there are fewer consumers to support and all of that. And plus, there's also more time to do work which is measured in GDP. Like bringing up children is a lot of work as well, but no one gives you GDP credit for that. So there is a lot more of saving that will happen. One manifestation of that is what we have written extensively on what India's business services exports are doing. And we think that if business services exports, the way they are growing, and I think we expect them to grow, that this will potentially take India to a current account surplus in the next 3 years. So that's the predictive aspect. Now, if you take a slightly prescriptive aspect to it, I hope that we don't get to a current account deficit, a current account surplus. And the reason is that in an economy where we have to grow really fast, a current account deficit shows that we are investing more than what we are saving, and therefore we're using external capital to grow faster. And I would rather that we grow faster than, but if we grow at 6.5-7% for 3 years, I think we'll most likely be in a current account surplus situation. The oil price being a major uncertainty, but if you sort of flatten that out, then I think the chances of us having a current account surplus in 3 years are quite high. And once we achieve that, then the macroeconomic stability just improves dramatically, right? So then we are no longer dependent on external capital. Then we are the control that the RBI has on interest rates will be all very domestic. So, but there are lots of ifs and buts. One of the things also is the fiscal deficit. Remember that the current account deficit to some extent also represents the fiscal deficit. So if the government of the day is not focused on macroeconomic stability, and the fiscal deficit starts to go up instead of coming down, then you will again have a current account deficit, and again, dependency on foreign capital keeps going up. So, but yeah, and on current, if I was to draw a straight line based on the current expectations, I think the likelihood of us becoming much more stable and a current account surplus country in 3 years is very high.
But despite all of this, you rather, for the sake of growth, because I remember from your earlier conversation that if we don't grow at a particular level, job creation becomes a problem. So you would rather have a non-current account deficit India, which is growing faster. Or other,
I would have the current account surplus. So non-current account surplus. So current account deficit country growing faster is a better place to be.
Got it. Great. Yeah. Thanks so much, Neelkanth. Much appreciate you taking the time out and speaking to us today, and have a great festive season.
Thank you. You too, Neeraj.
Thank you so much. And viewers, thanks for tuning in.